Welcome to International Securities Exchange's podcast series.
Now, the other beauty of this trade is that money can be made to the upside or to the downside. If the YUK, if the Japanese yen just tanks, meaning the US dollar goes way high, and let's say YUK goes up to 100 and the US dollar is really strong against the Japanese yen, then you're going to make a lot of money on that call option. The put will expire worthless, but you'll make money on the call. You'll make enough money on the call to make up for the put expiring worthless. On the flip side, if the market goes way down, meaning the Japanese yen beats the US dollar and the US dollar tanks, and YUK goes down to 80 or 70, then you'll make a lot of money on the put, and the call expires worthless. Now, that sounds all fine and rosy. However, it isn't cheap. And with this, to kind of expand on this, one thing that really scares me when talking about the straddle is people hear the good parts about it and they don't listen to the bad parts about it. Oftentimes the straddle is sold in the education world, in certain circles of the education world with which I've seen, as kind of a win-win trade. You can make money if the market goes up. You can make money if the market goes down. That's true. However, in my opinion, that's a half-truth. And my pastor always told me that a half-truth is a whole lie in his opinion. So with that being said, let's talk about the whole truth as to what a straddle can actually do. What's the risk of it? Well, here's the risk. If the market doesn't move, you're in trouble. I want you to look at the prices over on the side. And with that, see how we have the zeros at 85.89 and the other zero at 97.11. If the YUK, if the US dollar and yen stay within that range of 85 to 97, you're not going to make any money on the trade. It's impossible for you to make money, assuming you hold it until expiration, if it stays within that range. Your enemy is non-movement. So let's break it down. If you're bullish, your enemy is the bears, meaning if you're bullish and you think the stock's going to go up or the currency is going to go up, your enemy is the bears of having it go down. If you're bearish, meaning you think that the market's going to go down, your enemy is the bulls. When you trade the straddle, meaning a long straddle, the bulls are your friend, the bears are your friend. Your enemy is non-movement, and I don't know if there is an animal for non-movement, but we'll just say non-movement. Movement is your friend. You don't care which way it goes, but you need to respect your enemy. The enemy is large, and the enemy is very real. The enemy is if it does not move. And if the underlying does not move enough, you will lose money on this trade, assuming you hold it until expiration. So in terms of looking at a straddle, great news on the fact that it can go way up or way down, and you can make money on it. You don't have to pick the direction. But the bad news, and as Steve and I were talking a little bit before the webinar in terms of respecting the market, the bad news is if it does not move a lot, that's your enemy when you're looking at this trade, and that's how you need to respect the market. You're paying for a call and a put. You're taking on a lot of premium risk when doing this. Now let's talk about the long strangle. A long strangle is when a call and a put are purchased on the same underlying for the same expiration month, but with an out-of-the-money strike price on both of them. Now, you could do it within the monies, but out of the money is much more common, and that's what we're going to address today. Concept is the same as a straddle. It just is a cheaper trade. You don't pay as much money for it. So looking over at the risk-reward graph, you'll see that before, our maximum risk was, let's bring the other slide up, $5,600. $610 before commissions. Now, for the same underlying, if we go out of the money with both of them, our risk is only $2,900. And once again, this is on a 10 lot. There's no law that says you have to trade a 10 lot. You can trade less than that if you would like. With that being said, the premium risk is much less. So the most that you can possibly lose, instead of being over $5,000, is now less than $3,000. That's the good news. In terms of what you're looking for a lot of movement, either to the upside or to the downside, just as you did with the straddle. The enemy, once again, is if the stock, or in this case, YUK, which is the US dollar, Japanese yen currency pair, if it stays in the same area, That is your enemy when looking at this. Respect the market, know your enemy, respect your enemy. The enemy is if it stays the same. So why would you consider doing a straddle over a strangle? Well, the disadvantage is that it's less likely to be a profit. What I mean is look at the points with which you can actually take a profit. You're at the 85 and 97 level on the straddle. You're at the 85 and 97 level on the strangle, but it's a little bit further out. And with that, you're not going to make as much money quite as quickly because the options are a little bit further out with this. So it's kind of just whatever you prefer for what you're looking to do on the trade as to which one would work better. Now, of course, there's the other side of the trade too. There's the short straddle. Now, this is something that's pretty advanced, and I've traded for many years, and I don't think I've ever done a short straddle outright. I've done some short strangles, not a ton, granted, and I still will do a couple of short strangles, but I don't think I've ever done a short straddle per se. Not that I'm against it by any means, but this is a very high maintenance strategy. Short straddle is when a call and a put are sold on the same underlying at the same strike price and same expiration. At this stage, you'll notice, just look at the risk-reward graph, you have the V for the long straddle. The V is just upside down for the short straddle. Now, in this case, instead of paying the $5,600 or whatever it was to get into the trade and hoping for a lot of movement, now you're getting the money as a premium. And in this case, your enemy is movement. Both the bulls and the bears are your enemy as a short straddle trader. The stock, or in this case, YUK, which is the Japanese yen US dollar currency pair, need to stay within the same area for you to make money, assuming that you're trading direction. So with that being said, you need to really respect the market when doing this, because not only are you naked a put, you're naked a call. You don't know how much your actual real risk is. It's undefined and theoretically unlimited. So with that being said, you really need to respect the market when you're doing a naked option trade. This is something that's very advanced, and at both Options Express and Brokers Express, you have to have a level 5 trading clearance to be able to do this. Short strangle, same concept, except now you have a wider range of error, so to speak, in that you can see how there's a flat line up top with which you have more wiggle room, if you will. Same concept, you're naked on both of them, and you need to respect the market with stop losses, with some type of a hedge, or just something to respect your risk whenever you're trading naked options. So with that, I'm not against trading naked options by any means. I've traded plenty of them in my day, and it's worked out fine. I've had some that didn't work out fine, but that's a whole nother webinar. But with that being said, respect the fact that this can go against you in a major way whenever you're doing anything that's naked. Now, once again, why the straddle or the strangle? And from here on out, typically the reasons with which you would do them are similar for either concept, whether you're selling or buying a straddle or a strangle. Conceptually, it's the same trade, just kind of a different risk-reward. Three main reasons with which you would consider doing a straddle or a strangle, and let's go through them. First one is for delta. Let's say that you're looking at the currency, and you believe that XYZ currency, or a stock for that matter, is about to break out of a range. Maybe you're seeing the triangle pattern. Maybe you believe that there's an earnings announcement coming up, or maybe you believe that the interest rates are going to affect currencies in a major way like they did this morning in Australia. And with that, you don't know which way it's going to go, but you're looking at this thing and you're saying, wow, this thing's going to move, and this thing's going to move in a major way. I want to buy a call and a put because I think whichever way it moves, it's going to be a lot, and the gains on the one will erase, and then some, the losses on the other. So you buy a call and a put. That way, if it moves enough, you benefit from one while the other has limited risk. This is typically how beginners trade straddles and strangles. So with that, a lot of times when the market does move a lot and it goes your way, you're excited, you take your profits on the one, maybe you leave the other one on the table as a lottery ticket and then just move on to the next trade. Who knows? But with that, that's the concept of trading a straddle or a strangle for purpose of delta. You're looking for a lot of movement in the underlying.
Thank you for listening to our podcast.